everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 271 of our YouTube channel and podcast, and I could not be more excited to continue sharing with you guys personal finance topics that I think could be useful for you in your long-term financial journey. Today, we are going to be talking about a specific survey of Millennials and Gen Xers and Gen Zers, and this is called the Affluent Millennial Investing Survey that was done by Investopedia. And I think that we can learn a lot from the way that people answer certain questions that were asked of them via this survey. And I think that as a millennial myself, I can get a feel for how the rest of us are doing financially and how we feel about our finances and how I need to direct this show as far as, the things that I talk about and the things that we focus on day in, day out, week in, week out. So I think this is really interesting. It's something that you can take a lot away from, and we can learn some practical things along the way that apply to the way that millennials feel about their money and how they see their own financial situation. So stick around for all that and more in today's episode. Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, building some long-term financial goals that you can attain, and then ultimately pushing you on towards long-term financial freedom, which is what I hope for everyone who watches or listens to this show on a day-to-day basis. So back in 2019, a survey was done by Investopedia. And if you don't know what Investopedia is a super useful website that has all different types of articles and all different types of educational materials for investors, for students who are trying to learn about finance and economics and things of the like. And they did a survey on affluent millennials. Now, this doesn't just mean rich millennials. It just means millennials who are making over a certain amount of money. And we'll talk about what that exact parameter is here in a moment. But this was done back in May of 2019. And even though it's a couple years old, I think it's really useful because in the past 20 months, we've had the COVID-19 pandemic just ravage our country and our financial system and all the rest. And so I think if we can look back to 2019, we can really see how millennials have felt about money, because it's likely that the way that we feel about money may have changed a bit because of the crisis, because of the coronavirus crisis. But it's not likely that things have changed so much that you would find way different answers to a survey like this, okay? So this particular survey was done by Investopedia with Chirp Research in May of 2019. They obtained responses from 1,405 Americans, comprised of 844 affluent millennials aged 23 to 38, through an online survey, and compared their actions and attitudes to 430 Gen X and 131 Gen Z respondents. Affluent younger millennials were defined as those 23 to 29 with a household income of $50,000 or more, and older millennials as those 30 to 38 with a household income of $100,000 or more. The survey's median millennial income was $132,473. compared to the median millennial household income of $69,000. Okay, so this is a very interesting survey, and it deals with millennials that are actually making some good money. Right, these aren't millennials making $30,000, $40,000, and so it's going to be really interesting to find exactly how these individuals feel about their money. And so they asked these millennials about saving, investing, spending, all these different things. And here is what they found. And I'm going to roll through some of the findings and then pause from time to time to talk about what I teach and how it would apply to these specific areas. So retirement is the number one reason to invest for affluent millennials, and they prioritize it over paying down debt. Now, this is interesting, okay? I do believe retirement's one of the top reasons to invest, right? But there has to be a bigger why behind investing than just, I want to retire. And then it should be done, especially in large amounts, after paying off all your debt, after paying off all your household debt, because the fourth part of the financial action plan is paying all your debt off other than your mortgage. And then obviously the sixth part is 15% of your income or more towards your future, which includes retirement. Now, I do tell you that you can get an employer match before then in the third part of the financial action plan, but regardless, you should not prioritize investing over paying off debt in the way that they're saying that millennials do. Now, 64% of respondents said that retirement was the number one reason to invest. 56% said it's in order to live comfortably. 53% said feeling financially secure. And 44% said maximizing their wealth. Despite this, 46% say that they are not saving enough. So this is no surprise given what we just know about demographics in the first place. And it's the number one activity they say they need to do more of, investing is. 39% expect to be forced to work beyond retirement age, and 12% don't contribute to any retirement fund at all. So even among these affluent millennials, right, these millennials that actually have some good incomes, you still have 12% that don't contribute to anything at all, and 39% who are expecting to work beyond retirement age, which is really sad that individuals under the age of 40 can still be thinking, I'm going to have to work beyond retirement age, because you still have plenty of time and opportunity to put yourself in a position where you don't have to do that. So I think that is a sad thing, and these individuals who feel this way may not have enough information. So the results also revealed that despite their greater than average income, affluent millennials are still surprisingly reluctant to enter the stock market. According to the survey, almost 40% of this well-off cohort stated that they believe investing is risky, with nearly a quarter labeling it overwhelming. Now, this is one of the biggest reasons why I do this show on a day-to-day basis. And you notice that I talk about investing a lot. The reason that I talk about investing a lot is because I want to break down some of the barriers. I want to break down some of the things that really get in people's way when it comes to doing the necessary things in their financial life. And investing in the stock market is a very, very necessary thing. Unless you can invest your money in some other place, it's going to provide you an adequate enough return over time in order to retire on and live your dreams on. And for most people, the stock market is the way to go. But finding it risky or overwhelming has a lot to do with lack of knowledge. It has a lot to do with not understanding investing in the first place. And so that's why I'm trying to build your knowledge base and help you to understand investing. That way, it won't feel as risky. It won't feel as overwhelming when you actually know what you're doing. That's why I tell you all the time, know what you own, and you won't make as many emotional decisions as somebody who doesn't know what they own investing wise. Okay. Now, why are affluent millennials so wary of the stock market despite decades of evidence that investing pays off in the long term? Trepidation about stocks and a lack of knowledge about investing are major factors propelling the investment jitters of wealthy millennials in their study, despite the median income of $132,000. The survey revealed that less than half of affluent millennials feel confident about investing in retirement planning. In fact, only 37% of affluent millennials feel knowledgeable about investing at all. Again, going back to the root cause of why I'm doing this show on a day-to-day basis. If 37% of affluent millennials feel knowledgeable about investing, what about all millennials, right? What about all individuals regardless of their income? This means that 63% of the affluent millennials are not knowledgeable about investing. What about the rest? What about the rest of the millennials who don't make that much money, don't make enough money to find their way into this survey? I would venture to guess that a far larger proportion of them don't feel knowledgeable about investing, which is problematic, right? So we need to make sure that we can spread this knowledge to help you guys. That's what I'm here for. I'm here to help you guys feel more knowledgeable about your finances, about investing, so that you can go out and actually act on that knowledge. Now, financial knowledge encourages confidence and engagement. So those who feel knowledgeable are 5 times more likely to feel confident about making financial decisions in general. Okay. And then those who feel confident are 3 times as likely to say that they're highly engaged with their personal finances. And then those who are engaging daily are 2 times as likely to feel knowledgeable, right? So it's this, feedback loop basically, where it's like, okay, if you're knowledgeable, then you feel confident. If you're confident, then you're engaged. If you're engaged, then you feel knowledgeable, and then so on and so forth. And you can just gain in your knowledge and in your understanding of your finances and help to grow them over time. But the problem is the lack of interest. There's a lot of lack of interest of millennials and of individuals in general when it comes to their finances, and actually taking an active approach and actually stepping into an uncomfortable place may be exactly what you need to do. Because I know that the reason that a lot of millennials don't feel knowledgeable and they don't feel confident and they don't feel like they know as much about their financial decisions as they possibly could is because a lot of them are scared of it, right? It's scary to look at $100,000 $100,000 of student loans. It's scary to look at, a $40,000 car loan. And it's scary to think about, okay, I'm trying to move out of my parents' house and I want to do this and I want to do that. And but you're still saddled by debt. It's scary to look at $20,000 in credit card debt that just seems to grow and grow and grow, right? So when it's scary, the easy thing to do is to be apathetic and do nothing, okay? But what we have to understand is that if you actually lean in, right, if you're actually engaging, okay, then you can build your knowledge and you can actually make some headway forward. Now, high-income millennials who feel knowledgeable about investing are 5 times more likely to feel very confident in their ability to make their own financial decisions. So this was what I said a minute ago, and it was 73% to 14% in being knowledgeable about their investing. Further, affluent millennials who consider themselves financially knowledgeable are more likely to associate investing with positive emotions and less likely to find it intimidating, risky, or overwhelming. Okay, so in the very same way here, like I was saying a moment ago, a lot of the risk, a lot of the intimidation, the overwhelming nature of investing has so much to do with just understanding. It has to do with being knowledgeable and knowing what you're looking at, knowing what you're talking about, knowing what's going on. And if you just know what's happening, right, at a base sense, then you're far less likely to find it intimidating, risky, or overwhelming. And when you don't find something intimidating, risky, or overwhelming, what are you likely to do? You're likely to engage in that thing, which is what we need to be doing in the first place, okay? So millennials know that they should invest, okay? And that's what I think is the big disconnect here, is that they know that they should invest, but they're so overwhelmed by the thought process that they just don't. Knowledgeable millennials are significantly more likely to select the positive associations responsible, smart, and necessary with investing than the negative associations, which is intimidating, risky, overwhelming, and complicated. Okay, one millennial said, "It gives me a feeling of control and power. I feel in charge of my own future by handling my finances correctly," said another. "I love crunching numbers and seeing how I can grow my wealth," said a third, suggesting that despite some trepidation to invest, affluent millennials are still seeking a sense of control over their financial futures. And I think this is true of almost anybody, right? We want the control over our finances, right? We like the feeling of being in control and being able to handle your finances correctly and making good decisions. But if you're afraid of your finances, if you're afraid to actually look in the mirror, if you're afraid to look at your own situation with a critical eye, then it's going to be very, very difficult to make any change and actually get to the point where you're doing something constructive in your financial life. And it's going to be even more difficult to get into the investing habits that you need to get into. So low financial confidence manifests in conservative investing habits. The study found that affluent millennials, despite having a longer window to invest and recoup losses, displayed surprisingly cautious investing habits. They're significantly less likely than Gen X, so Gen X is the older generation, the one generation above the millennials. They are significantly less likely than Gen X to own stocks. So millennials, 37% of them are likely to own stocks, and 47% of the Gen X's are likely to own stocks. But just as likely is Gen X to own bonds, 19% versus 18%, and more likely to allocate their income in a low yield savings account, 21% versus 16% for the Gen Xers. Okay, so this is really appalling, right? It's really crazy, especially for these millennials who have more time, who have more opportunity, have the ability to take more risk, and yet they're not. Right? Now, I think this can be attributed to multiple things, and we'll get into some of the root causes here shortly, but I think that this can be attributed to things like the millennials having lived through multiple crises, right? Seeing the stock market crash multiple times, right? If you're in your 30s, you've likely seen the stock market crash, 3 times of over 30% in your lifetime, and that can be scary, right? And 2 times of 50% plus in your lifetime, which again can be scary. Okay, so it's no surprise that a millennial may have some fear, may have some anxiety about investing in stocks, and they want to keep their money safe, so they'll put it in a savings account, right? Or they'll take less risk in their portfolio just because they are afraid of what could happen again. But this has to do with knowledge. It has to do with understanding what you're investing in, okay? Because if you do not understand what you're investing in, then it's going to be problematic. It's going to be an issue. You're not going to have the knowledge base to actually make informed decisions, and you're likely to just take an easy road. Now, this could also have to do with the fact that Gen Xers are getting older, and with Gen Xers getting older, they're realizing the need to take risk now. They're realizing the need to go ahead and act more risky, to take more risk. Even if they don't understand what they're investing in, they're trying to get all the returns that they can because they know that they want to retire soon. And the only way that they're going to be able to retire is if they actually go and invest in a riskier way. So it may have something to do on both sides, but Gen Xers are 10% more likely to have stocks in their portfolio, right? Now, conservative investment wise, it's really, really interesting. I said bonds were 19% to 18%. High yield savings accounts, right, are 21% and 21%. So they're basically the same. But the low yield savings accounts is where it was 21% versus 16% for the Gen Xers. So the Gen Xers overall are putting less money into savings accounts and more money into investments. And then annuities, 9% of millennials to 11% of Gen Xers. CDs, more millennials are putting their money in CDs than Gen Xers. Again, this is just an appalling stat, especially given what we've talked about before with CDs and some of these other types of investments, that the individuals who would have longer and more ability to take risk over time are the ones that are partaking in these particular investment types. So it's interesting, but it's also very sad because a lot of individuals are missing out on their ability to make returns over a long period of time. Now, why do affluent millennials display an aversion to entering the market despite a larger income to work with? Fear of losing money, founded or otherwise, is the main reason people think investing is too risky for them. Okay. Indeed, the Great Recession, the gig economy, and the burden of student loan debt have rendered millennials a cautious generation. Yet their fear is a catch-22. Coming of age amidst a global financial turbulence alerted them to the importance of avoiding risky financial decisions, but investing could play a crucial factor in making up for the stagnant wages of the post-recession generation. And if you just look at the total buckets of what Gen Zs invest in and millennials and Gen Xers invest in, millennials and Gen Zs are very, very similar as far as low risk investments, high risk investments, real estate, all those things. They're all within 1% or 2% of one another in those allocations. But you look at Gen X, right? And Gen X has more in low risk investments. They have more percentage in high risk investments, right? They have less in just traditional savings. They have less in their checking accounts. They have a little bit more as far as the real estate portion goes. They have less cash than the Gen Zers, yet the same amount of cash as the millennials. So these generational gaps are real, yet you look at all these pie charts, all these proportions, and they are all very, very similar. But as a group, human nature, they all kind of fall into similar buckets. But it is interesting to know that the Gen Xers are far more serious about their investing than the millennials or Gen Zers, which this is no surprise, but it's going to end up coming back to bite the Gen Zers and millennials if they don't get their heads on straight really, really quickly. They have to be investing and they have to be willing to take more risk than the Gen Xers. Okay. Now, what's interesting here is that many millennials still trust and hire financial advisors. Raised in an era of economic uncertainty, it's no wonder why many millennials with money seek professional advice. 43% of the affluent millennials surveyed said that they use a financial advisor. And those who consider themselves knowledgeable about investing are 2 times as likely to have a financial advisor than their less knowledgeable peers. Notably, 27% of those who reported using a financial advisor said their investments perform extremely well. Double the number of affluent millennials without financial advisors who said their investments perform extremely well. So this is very interesting. It's showing that financial advisors have some value, especially for the millennial generation, which is no surprise. Good financial advisors can provide a lot of value and can help you to maximize what you have, and they can teach you, right? Good financial advisors should be teachers, and they should help you to grow your money over time and be more knowledgeable and be more confident about how you invest, okay? But at the same time, this all really comes back to knowledge or lack of knowledge, right? If a good financial advisor is a teacher and they're helping you to invest in a proper way, then of course that is going to help you to be more successful in your investing. But those who don't perform very well are likely not using a financial advisor, and they're not very knowledgeable. They're just kind of winging it. And it's no surprise that those individuals can easily drop out of the market or easily not feel so great about putting more of their money, quote unquote, at risk because investing is overwhelming and they don't understand it. Okay. Now, again, 43% of affluent millennials have a financial advisor, right? And they are 58% more likely to do so if their parents had financial advisors. So this is very interesting. They kind of copy what their parents do. Nearly 2/3 of millennials, 65%, surveyed said that they trust financial advisors, compared to only 58% of Gen Xers. Okay, so millennials have a little more trust there. They also trust books, 58%, TV shows, 54%, newspapers, 53%, podcasts and radio, 49%, magazines, 48%, websites and blogs, 37%, and YouTube or similar video platforms, 27%, which I don't blame you for not trusting everything that you find on YouTube or whatever, but I am here. I'm on the podcast and I'm on YouTube, so you can come here for something that is actually going to help you, and you can trust what I'm doing here, because I'm not trying to sell you anything. I'm just trying to help you with your financial life. Okay, now, the affluent millennials surveyed explained why they trust financial advisors the most. I feel the personal connection that gives them more stake in my success, said one, because they have received the most training, schooling, etc. in the field and are the most knowledgeable, according to another. Other affluent millennials cited the ability to have a two-way conversation and develop personalized strategies, and the belief that financial advisors are accountable since their careers depend on knowledge and expertise. Okay, for millennials, financial advisors are the number one trusted source for financial advice. Now, the way affluent millennials feel about managing their finances often reflects how effectively their parents manage money. Okay, that's why I tell you guys, more is caught than taught, right? Parents may teach their kids stuff about money, but you ultimately have to show your kids how to manage money effectively. Only 9% of those who said their parents were good at managing finances said they feel, quote, very anxious about managing their own money as adults. And this is no surprise, because if the parents were good at handling their finances, they likely put a premium on doing so with their children, okay? And so those children likely don't feel anxious about managing their own money because they understand it. This is compared to 24% of those who said their parents were not good at managing finances, saying that they feel very anxious about managing their own money as adults. Conversely, among respondents who said their parents were successfully managing their money, 46% have high confidence in managing their finances, compared to only 30% of those who said their parents were ineffective at managing finances. So learning earlier increases financial confidence. Millennials who are currently affluent didn't all grow up with the same experiences. Okay, so the question was asked, when did they first learn about investing? So if they learned before age 15, they were 2.9 times more likely to feel knowledgeable than not about investing today. Okay, so if they learned early, they were far more likely to feel knowledgeable than not about investing today. Okay, if they learned after age 21, they're now 1.7 times more likely to not feel knowledgeable about investing today. And if they learned between ages 15 and 20, they're still 1.6 times more likely to feel knowledgeable than not about investing today. So what we find is, before your kids leave the house, before your kids get out on their own and they're, full-blown adults at, 18 to 21 or whatever, right? You need to teach them about finance. You need to show them how to deal with their finances and show them what's going on with investing, and then they can actually turn that into their own financial success. Okay, now, the question that you may have here is, why affluent millennials? Why didn't they just pick all millennials? Well, Investopedia sought to examine what motivated investment decisions for a generation that came into adulthood during the Great Recession and has notoriously encountered a variety of challenging economic factors. In order to understand attitudes around investment, they studied those who should have disposable income enough to invest, referred to as these affluent millennials. By examining a segment of the population that makes greater than average yearly income for their age group, they hope to eliminate financial hardship from the reasons that they may not invest. And like I said earlier, some of these numbers can be very, very materially impacted by just including millennials who have no knowledge, who don't understand investing at all. And it can be very, very clear that you have to learn about money early, and that knowing what's going on can actually give you some confidence in doing what you're going to do as far as your investments go. So what's the bottom line here? Okay. This survey revealed the importance of financial education, as evidenced by those who have learned about investing as a teenager, feeling confident enough to invest as an adult. Further, observing how their parents manage finances has shaped many affluent millennials' confidence as adults as well. Earning a good income alone doesn't always go hand in hand with knowing how to invest or feeling comfortable about managing money. And I've told you this from time to time, that you cannot outgrow or out-earn your stupidity. right? Now, you can't out-earn not knowing what to do. You can't out-earn somebody who is investing systematically over a long period of time. You can't out-save them. You just absolutely cannot, because they understand something that you don't. They understand compound interest. Now, based on the findings of the survey, there are 4 ways affluent millennials can plan more effectively for their financial future, and I'll provide a little bit of commentary for each one of these. Affluent millennials should contribute to a retirement account even if they're not concerned about their finances. 12% of respondents said that they don't yet, despite their income. Okay, so I agree. You should contribute to a retirement account, but you need to do so in the right order. You need to make sure that you do have an emergency fund. You need to make sure that before you really get to investing at a high rate, putting away 15% plus for your future, then you should be out of debt. You should have an emergency fund. You should be budgeting. You should know where your income's going. Okay, so you need to lay a financial foundation for yourself. But yes, by all means, you should be contributing to a retirement account, getting some of those tax advantages and allowing your money to grow for the long term. Then, for those that do invest already, they should save even more for retirement. 46% said they didn't even feel like they were saving enough, even though nearly 8 in 10 affluent millennials said that their saving for retirement is a top priority. Of course, right? We need to be putting away enough. That's why I tell you 15+% of your household income for your future, because that should get you to a point where you'll be able to, have enough money for the future. And for most millennials, that will get you to that point. Time value of money and compounding demonstrate how investing more and earlier can add hundreds of thousands of dollars over the course of a lifetime, and in some cases, even millions, right? The more time that you have and the better rates of return that you make, then you'll be able to get to where you want to get to even faster. Okay, now the rate of return thing, that brings us to this third way that affluent millennials can plan more effectively. Invest less conservatively. That's a key. Affluent millennials can afford to take more calculated risks with the goal of earning higher returns, as they have both the advantages of time and more money to work with. Okay, to be honest, there is volatility. There are vicissitudes, as Ben Graham says in The Intelligent Investor, but ultimately, there is not a huge risk of loss. There's not a huge risk of things going to zero over a long period of time. That risk is actually minute, very, very, very small. The likelihood is if you invest and you take a little more risk, maybe in small cap stocks or emerging market stocks or, whatever it may be, taking a little more risk over time is going to be okay. Investing in the stock market over time is going to be okay. You're going to earn higher returns, and you have the time to make up for any short-term losses that may occur. I was 24 when the coronavirus crash occurred, right? But I knew that, hey, I have plenty of time. There's no reason to freak out. Stay invested and add more on, because over the long term, your money's going to be worth way more than it is today. So take more risk. Don't invest as conservatively. Then finally, working with a financial professional can alleviate economic anxieties. Affluent millennials report substantially better investment performance when they work with an advisor, and having expert advice can help avoid missteps and missed opportunities. I don't disagree with this. You can learn a lot from a financial advisor. You can learn a lot from somebody who is going to teach you how to invest, but you have to be very, very clear and understand that they are not investing for you. You are the investor, right? They are the teacher. They are the guidance counselor, if you will, right? They're just teaching you how to do what you ultimately need to do. And they can provide you options, but you make all the decisions. And you also have to make sure that you aren't overpaying for what they're doing for you. They may provide a good service and teach you a lot and make your gross performance of your investments higher. But ultimately, if they're charging you way too much and it's eating away at your returns, that is going to be problematic as well. Okay, so they can be a perfectly good tool, but they can also be somebody that can hold you back if they are charging you too much, or they're trying to take advantage or do things in a way that is not best for you over a long period of time. Okay, so ultimately, we need to take these things to heart. We need to understand that as millennials and even as Gen Xers and Gen Zers, right, that financial education is so important. And we need to be teaching our kids about finances. We need to be very, very intentional about that. And we need to try to get ourselves in the best position possible to live out our financial dreams. And the only way we can do that is if we actually put both hands on the wheel and take control, and we actually decide that we are interested. We decide that we're willing to look that mess in the face and go and try to clean it up. Or, we're deciding that even though, we want to live our best life today, we can and should make some sacrifices for the long term in order to get to where we want to be, because it's going to be so worth it if we just sacrifice a little today, because we'll have a lot for that little sacrifice later on. So hopefully this helps you guys to understand a little bit more about how we think about money, and a little bit more about exactly what millennials are doing with their money and how they are doing as far as their investing lifestyle. So thanks for watching this video. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I'll be sure to respond to anything you leave down there. If you're listening on Apple or Spotify podcasts, be sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's really good supplemental materials to all the things I'm putting out in these long form episodes on YouTube and the podcast every single day. And then if you need somebody to help you to build a financial plan and keep you accountable to that plan over the long term, then I can do that. Just DM me on any of the major social media sites and tell me that you are interested in financial coaching sessions, and you and I can begin working together, pushing towards some long-term financial goals for you and your family, and ultimately pushing you towards long-term financial freedom. So tune in tomorrow as I continue talking about personal finance topics that I think could be useful for you in your long-term financial journey. So thanks for tuning in to this episode of Money's No Object. I'm your host, Dylan Howell. God bless.